Okay, now we are actually going to switch gears here. As we told you before, as we teased to, we have a special guest in studio. Tim Fitzwilliams from Fitzwilliams Financial joins us here on Live Impact News. Tim, it's great to have you in studio. How's everything with you? We'll just start there.
Everything's great. Very blessed. Things are lovely. Thank you for having me.
Yeah.
I always love being able to come out and just talk about the market and life and economics.
Well,
It's
good.
my passion.
When I heard you were coming in, I knew I should have wore a suit today. I knew you were going to come in looking fresh. So next time we have you, I'll get suited up as well, and we'll be good to go. Now, we were talking before we came on air, and I actually want to start somewhere that is not, kind of your area of expertise, which is
Sure.
that you just told me that you guys have a podcast now.
Yeah, we do.
Can we just dive into that quickly? What
Yeah,
compelled
absolutely.
you to start a podcast, and what kind of things do you go over?
Yeah, so I've been doing dinner seminars. I've done countless, hundreds of dinner seminars here and up and down the coast, really, in our various branches. And, I realized that there's people not coming to dinner seminars and maybe not listening to our show on the radio. And how can you reach these people? How can you hit a younger generation? Or how can you reach the generation that wants to just be more by themselves, whether it's going to look at on their iPad or on their phone? And so podcast was kind of the answer. And so we really started recently to really ramp that up, doing multiple shows, making sure that we're getting fresh content. And it's really fun because we have my wife on there, who's the backbone of my business, and she was with me from the beginning. And she's there with her input, right? She's not in the business per se as an advisor or whatever, but she is there, as an executive and helps make decisions. So, but she talks with a lot of people, a lot of clients, a lot of widows and whatnot. So to hear her opinion from a very grassroots standpoint or after someone dies standpoint is really nice, right? To have that kind of opinion. To have me as an economist and advisor, to have my chief investment officer, who also is kind of hosting it, that's Brian. And then we have our chartered financial analyst, which is very rare to have in general, but to actually have one even want to get on the screen is almost impossible to convince those guys to get onto something. So we have him there from our office in Coral Gables, and we're all just kind of there having a good time, and we're talking about the market, we're talking about how things work and whatnot. And a lot of times we don't stay on script.
Right.
We go off on a tangent, but it's so fun, and you get that raw back and forth Q&A, playing devil's advocate, really trying to understand how things are or why you need an advisor, or should I worry if the market drops, or if I'm at the last day of my job, what should I be thinking about, right? I'm in retirement or I'm going into retirement. And you can spend some time really going through that. Whereas in a seminar setting, you have a script, you want to kind of hit all markets and talk. And a lot of the times you're set. You really can't have a Q&A or the whole room will talk for like an hour, right? So you're kind of going down a more of a scripted path.
Right.
Podcast a little more loosey-goosey, and you can have some more fun.
And that's kind of what we've tried to do here on Live Impact News. Regular viewers of this program know that we'll do a tangent every once in a while as well. We are not immune to a tangent. I think it's great that you guys are embracing new media. And you mentioned meeting the next generation where they are, bringing the information to them. I'll stay with that for just a brief moment here. I'm wondering, in working with the next generation, or at least observing, have you noticed any differences with the next generation when it comes to their money management as it compared to maybe generations before?
Yeah, I have.
Yeah.
Because of social media, in my opinion, just as opinion, this isn't financial advice, but an opinion, social media, the ability to have information at your fingertips, taking advice from influencers and maybe people that haven't really been vetted, it creates a sense that you know what you're talking about. And I think we have to kind of go back to our roots, right? In economics, we call it do what you do best and trade for the rest, right? If you're not the financial advisor, it's okay. You can be a doctor, you can be a lawyer, you can be an engineer, you could be AC technician, you can be whatever it is you want to be in life. You don't also have to be that too. And I find a lot of younger folks think it's kind of cool to feel like, oh, I'm on the cutting edge of my portfolio. I understand Bitcoin. I understand this. I understand that. And it's cool to thirst for knowledge, and it's even better to be able to get that knowledge, but to actually execute and plan your future, that I believe is dangerous because you're not an expert.
Right.
You're not doing this for a living. You're not doing this under a fiduciary capacity where you have to make decisions that are prudent where you're looking at things and doing proper research.
And we saw this
And
during the
a quick Google
GameStop
is or
situation.
ChatGPT doesn't do it.
Right. And we saw this during the GameStop situation a
Right.
few years back where
And that was
people
so-
were diving into that market and they weren't ready to do so maybe in some
Man,
cases.
I can't even say what I want to say on air.
Yeah.
I told you what a chartered financial analyst. Let's just go there for a quick second, can we?
Yeah.
A chartered financial analyst is the top of the top, the smartest of the smartest when it comes to the financial markets. Wall Street Journal says it's one of the hardest tests in the world to pass, okay? So that's who manages our portfolio, a CFA. Normally you need around $10 million to even talk to one. Would it be crazy, or how crazy do you think it would be if I told you the guy who orchestrated, who wasn't given financial advice, who didn't have a plan, who wasn't premeditated, was a chartered financial analyst? You tell me how you can be a CFA and not have a plan that you're going to execute.
Right.
But no, of course, he claimed he had no thoughts of trying to make money off of that, right? So it's very sad
Yeah.
because someone gets out there, says something cool, builds some hype, continues to build that hype, builds it up, and then pulls the rug. And you want to know who gets hurt, man?
The people who invested, the common people who are investing, thinking they're
The
following
9 to
sound
5
advice,
worker who's just getting
trusting-
enough time to look
Right.
on Google or maybe hear a quick podcast or watch a quick TikTok or Facebook and hear about something, get excited about shorting GameStop, and they don't even know what shorting is.
Right.
And that's where the rubber hits the road.
Yeah.
What I was saying is, for the younger generation, don't try to be the expert if that's not what you do. It's
And-
cool to learn.
And you know, as you grow, and this is something I've had to kind of grow into as well, is one of the smartest things you can do in life is to know what you don't know and be comfortable with that and act as such. And so I think that
100%.
gets to what you're saying.
In
yeah.
economics, we call that comparative advantage. You're 100% right. That is the key to my success, my firm, and how we live our personal lives as well at home. Do what you do best and trade for the rest.
Luckily, this is what you do best. And so
It
we
is.
have you here. We're able to ask you a few questions about kind of our current situation here with the stock market. Let's just start with today. From my sort of very surface level research, the stock market down a little bit today. Personally, I would have thought, with very little actual, study or knowledge, that with the government reopening, we would have seen a bump today. Not the case. Would you be able to kind of ascertain why?
Yeah, so when you have uncertainty, you have market reactions. And so during the shutdown, people were not collecting data because the government was shut down. So we don't have the accurate numbers for GDP and things like that, these economic indicators, if you will. We don't have accurate data. So when you have this uncertainty, what happens? You kind of pause for a second, right? You're not going to dive right in.
Right.
So you pause for a second. Well, what do you think the Federal Reserve does? They start to say things like, well, we'll have to see. We're going to stand a little more conservative when it comes to an interest rate cut. And so when you whisper these things out into the world of information today, and you're lacking the information to be able to make a proper forecast, that uncertainty can create a market reaction.
Right.
And so that's what I believe it is.
Yeah. Yeah, and the government shutdown, we just more and more impacts that you don't even see,
Right.
where each people in their specific field is able to look and say, hey, this is even affecting this or that.
It is, but it's not going to be a big deal.
Right.
We're in a good spot.
Yeah.
GDP Q3 was awesome.
Yeah.
We don't think there's going to be much inflation. Tariffs have been internalized by the companies. They haven't really been pressed on the consumer much because the companies were having record profits and they did the right thing and internalized it a little bit.
Yeah.
So I think we're going to see a bigger Q4. The people that were furloughed for that time are going to be back on track. They're going to have their income coming in, and they're going to enjoy a wonderful Christmas, and they're going to spend. And I think we're going to see more of a spending Q4 than we have because they're going to be like, hey, we couldn't do that trip. Wait, well, we didn't do that trip. Well, let's go do something else. And so people are going to be excited to be back in the workforce and be able to spend money. And I think it'll be reflective in the market. So I'm not concerned at all. But there's a reason I'm not concerned. It's not just because of the theory of, hey, as the data comes in, everything's going to be okay. So would you like to understand my main reason of why I'm not concerned?
Please.
So if you aren't worried about the down in a market because you know how to lose less money or make money when the market's down, then you're never concerned. You see, you have to ask yourself, does anyone ever really beat the market? I know this is coming from a market guy, right? Like, no one beats the market. So there's schools of thought. You either believe there's someone out there that can do better in the market than you, or there's not. And so if you believe there's someone that's better, well, what's better? I just said you can't beat the market. So how do you win? Why is there minimums of $10 million and dollars like that to get into Goldman Sachs and these big companies, right? And why would people with $50 million give their money to them? No one ever stops and asks those questions. Is it because they're getting better returns? Because they're losing less. If you can lose less in the market and then ride the wave back up, guess what? You're going to have more.
That's kind of the combo you want.
That's the whole concept of what I built my firm around, is to lose less in the downside, to hedge more. And by using a chartered financial analyst, you can do things that most people would struggle to be able to do on their own. Kind of like the GameStop short. What if you could, short bonds when interest rates went up? That would prevent less loss, because when interest rates go up, bonds go down, right? That's basic economics there. But if you could hedge or make money as bonds went down, as interest rates went up, you see what happens there? Then you don't care. So the idea is, if you always have a sell plan when you make a buy, you're not worried. And that's why I can have that carefree attitude of, I know everything's going to be okay, because even if it's not, my team, our portfolio managers, will be able to pull the trigger today if something happens. And that gives me peace of mind.
And you talk about your peace of mind. You talk about how you know everything's going to be okay. Something that, a dichotomy that I have maybe observed in some of my own personal conversations or some of the reporting that we've done, is there can be confusion around how maybe the market will be okay. And we've seen instances where the market is doing well, but everyday people are struggling with cost and struggling with affordability. And it doesn't feel in maybe your day-to-day life like things are okay. And then that does not seem to be reflected in the market. Why the chasm there?
At first, when you said that, I was thinking, how does that work? And why is he saying that? And then I thought about it, and it just clicked. And it's actually kind of interesting. Are you aware that like 34% of what we call the market is like 7 companies, give or take?
Right. And I have also heard that statistic before.
The Magnificent Seven.
Right.
So if they're so large and they control the market, then those feelings aren't going to be seen. You see, it's not the weighted average, right? It's set up in such a way that these larger companies are going to have a great impact on the market.
Right.
And if they have all this profit margin, like a Tesla or Google or an Apple, everyday people are still buying Apple. So it's not going to be reflected in the emotions. But if everything was weighted equally, right, then that'd be different.
Now, is there a downside to that? What you just described.
Absolutely.
What's the downside to
goodness.
having 7 companies that are so drastically valued heavily than others?
I talk about it all the time. I'll talk about it tonight. You can't diversify properly. It is so difficult to diversify. If you have a mutual fund and I have a mutual fund and she has a mutual fund, do we all have Apple in that mutual fund?
Most likely.
So how are we diversified?
Right.
That's the crazy part, right? It's so hard to be diversified if there's that much weight. So one of the things that we, again, give us peace of mind for ourselves and our clients is that we make sure that we don't have too much heavy concentration. We keep it very light. Even in the ones that we know we have to be in, like NVIDIA, to make money, we're still not going to push too much. And so that's the idea. It's difficult to diversify when you have these monsters that are controlling the market. But the sad part is if you're not in with them, you won't make the money.
Which only enhances their control in the market.
Exactly.
Is that a cycle that does there need to be a focus on breaking that and adding more diversity in people's investment options?
I mean, so that's saying, like, is the market in a balloon, right? At some level, yes. Mathematically, there's formulas. Like, it's not just emotion.
Right.
There's actual formulas, price to book ratio, various other nerdy formulas that are out there that say if a stock is overpriced or not. And, yeah, some of these PE ratios, some of these valuations do not make sense. It's not like they came out with a cure for cancer.
Right.
In fact, you go back to my generation, it's kind of crazy because you look at on a Friday night going to a Blockbuster to pick up movies to watch. But now we stream.
Yep.
It didn't even exist. So what that tells us is that volatility can come at any moment.
Right.
If tomorrow, just think this through for a second, if tomorrow some random company effectively designed and executed the release of a car based on water, what happens to the electric car?
Right.
You see, just like that. So yeah, when you're overvalued and there's no real economic data and good accounting to prove that you should be valued at that level, except for hype,
Right.
like NVIDIA, for example,
Yeah.
then it can create a major problem when there's an issue of competition or volatility. And there's going to be volatility. There's always volatility.
Right. That the constant is volatility. Now, well, let's talk about NVIDIA because you've touched on that a couple times now. And is this just a unicorn, what you have seen with NVIDIA over the last, year, 18 months?
So, again, I can't give advice per se, right? Because that's not what we're allowed to do as fiduciaries. But what I can say is this. If you run the math and you go and anyone can Google PE ratio, anyone can Google, how to evaluate a company, does it just make you feel uncomfortable when you see something that overvalued? That's where you have to stop and think. Could another chip manufacturer come out and beat them? Maybe. What happened, earlier in the stock market in recent times, a random tweet came out and said that it could be more effective, right? There was a random tweet by a company out of China that said it could be more effective, and it lost, 18%. Just a random tweet. Now, of course, it comes back. I'm not arguing that.
Right.
I'm just saying, isn't that the definition of volatility? So, is it a good stock? Is it bad? I'm not going to say that. I'm going to say, is it properly valued? And then, whether it is or it isn't, do you know how to manage something when it's not properly managed or properly valued? And that's where we get back into we have to let the experts do it because you got to be able to pull the trigger and get out if you can get out. And the problem is most people can't get out fast enough. In their 401k or with their advisors, they got to wait till a quarterly review, right? So it gets very difficult for everyday working folks to be able to move quickly in and out of something. But I think it's great. I'm not saying that as a recommendation. I think it's a great company. I just think it's overvalued.
Right.
So you got to know how to deal with that animal.
And that overvaluing comes from the vicious cycle you were talking about. It's a little bit of a rocket ship, more people invest, and now it starts to build. Now, we're going down a little bit of a tangent, but how does the system reform itself to where we do not have these stocks that are overvalued based on their actual production and work?
That is such a deep question.
Right.
Because you want to be careful because you want to not execute too much legal work, like too much government intervention, because then you have controls and it can really mess things up.
Right.
It's supposed to work naturally. And so if you can let it work naturally, it should break, but it's gotten so big, I don't know that it can. So again, I fall back on be prepared, have a selling plan, be prepared to pivot. Don't just always think everything's going to be up because the downs can matter. So it's hard, man. I don't know that it can go back to normal.
Right.
You've got a lot of movement. I think what you're going to see before it goes back to normal is a competitor that's going to create a major wave in some of those Magnificent Sevens to the point that it crumbles them. Just like it happened back in the day with Blockbuster.
Yeah. And I guess that maybe the rise of Netflix and Netflix taking its perch as one of those top secure, I guess that should be encouraging, that it can happen.
Right.
It takes sort of almost an industrial-sized shakeup to make it happen, but it is possible.
Technology normally leads that.
Technology normally leads that. Now, you mentioned something else interesting, which is that a simple tweet was so impactful to the stock market. And that is a relatively new phenomenon.
That is so scary, man.
We'll talk a little bit about that.
And I was saying 10 years ago at dinner seminars, as I was watching my son watch, the YouTubers like the Mr. Beast and the people that are out there.
Mm-hmm.
And it dawned on me that one day these people are going to have so much influence through social media that if they say, I think Coca-Cola is bad, look out for the Coca-Cola stock.
Right.
And that's just crazy.
Mm-hmm.
And so, yeah, a tweet today can cause volatility in your portfolio.
And people who have a vested interest in stocks going up or down can work their way into those sectors of influence.
Yeah,
whether it's
so
through
you get into
or,
some legal guidelines there. Are you
Right.
doing illegal things?
Right. Right. It is
You
scary.
know, and that gets scary, just
Yeah.
like that short of the GameStop.
Right.
Can you really be a chartered financial analyst, considered one of the best in the world at understanding the financial markets, and claim you didn't have a personal interest in hyping up shorting GameStop?
Yeah.
Come on.
And I would imagine based on how
That's
you don't
tough
expect
for me to swallow.
Right. And the situation that happened with GameStop, you don't expect that to be a one-time thing. You expect that to be something that
I think there's always people trying to find a way to take advantage.
right.
I want to be clear. I think this is an important point that we should make.
Mm-hmm.
Those people aren't fiduciaries until they actually say and state and are licensed as a fiduciary, which means you put your client's interests ahead of your own. Not every financial advisor is a fiduciary. Not every stockbroker is. Not everyone is a fiduciary. Not every insurance person. It's special, and it's a license, and it's legal, and you're held to a standard. So I think the main thing is make sure you're working with a fiduciary at some level if you are going to look for help. And check and see if the advice you're getting, whether it's through social media, Reddit, or whatever, if the people that are talking are fiduciaries. Because you want to know the truth, as I'm talking to you today, we're
Right.
gated. We're not really allowed to say too much.
Right.
And so we're not out there on Reddit. We're not out there in social media really saying a whole lot. We have to be very cautious and say this is not advice. This is an opinion, based on some theories and some ideas, but it's not advice for you or for anyone listening.
Which is also why it's so it's more secure to go to someone who
Right.
has to adhere to the rules of gatekeepers, because it means that they are going to be giving you the most sound advice that they can find based on their expertise.
And that's where we get into why not Robinhood, or why not some AI stockbroker account? Because I
Right.
want the cheapest price. And so the idea becomes, what is price? Price is subjective. Value is subjective. There's a reason people buy Rolex, right? Because they place value on the brand name and on other brand names, right? So if you can get value out of paying a fee, then there's nothing wrong with paying a fee. If you're not getting value, then it makes a big deal.
Right.
Look, if your cousin or uncle or brother or sister is managing your portfolio and NVIDIA crashes today and you take that full loss, but we have someone in the exact same portfolio as you, but is managed differently, and something happens with NVIDIA today, and our client doesn't take the full loss because we did something today, is there a value there? Is there a value that we lost less?
Absolutely.
And I would say yes.
Right. Right.
And so then you could even go so far to say, who's more expensive? The cousin doing it for free, or the paid advisor that's admittedly more expensive than most?
Right. But will ultimately, hopefully, in theory, bring a greater return.
And if it doesn't, you leave.
Right.
That's the name of the game. But people get excited, especially young people, try to find the best deal. You don't want the cheapest and the easiest. Nothing worth having is easy to obtain. Remember that, everyone. That's one of the main things that I've learned in life.
Yeah. And you talk about how young people, they are more prone to some of these mistakes, but it also seems like they are perhaps more thoughtful about their financial futures earlier on because they have access to such a breadth of information. Would
I
you
do
find
think
that
they're
to be
more
the
thoughtful
case?
about it. Yeah, I
or more
noticed
concerned
that.
about it, at least.
Yeah, definitely more
invested
concerned, more thoughtful, more research. It's just, again, because if you're thoughtful about it, are you getting the right information? And going to Reddit and going to things like that if we're Googling a strategy on a video game, which I'm a huge gamer, so I understand, so I'm around a lot of young people. I'm
Right.
in Discord, all that stuff.
Right.
I live that life. So, and with my son as well, so I understand it. That's not that's, you know, that's not the way to do it.
Right.
So you want to seek a fiduciary to get the advice if you have questions. And most fiduciaries will talk to you without charging you and just answer some of your questions.
Right. Right. And
just to help you understand and be on the right path.
Now let's talk about something that more and more, as Naya builds out her broadcasts, as I sit on the anchor desk, more and more we have stories about artificial intelligence.
Oh, yeah.
Real use cases, being involved in city government now to some degree.
Absolutely.
Everywhere you look, this is one of the topics du jour.
Yeah.
When through your lens, through your lens of expertise, how do you view
Oh, man,
AI?
it's a great research tool. We use AI. We use advanced AI. We love it.
Well, in terms
But
of...
is it able to give us emotion?
Right.
No. So when the young person comes in and is like, I want to start my career, here's my anxieties, here's my feelings, here's my concerns about life. I might not stay in this job. Help me build a financial plan. AI can't interpret that. And
Well, of course.
And it never will.
And I hadn't even thought about it from that angle. It's interesting that you took it there. That's something that we think about as well here, working in local news. I more so meant as a tool for investment in terms of, is this something that you guys are looking at as maybe an AI company that will rise to be one of those pillar stocks?
We don't look at it from that standpoint.
Right.
We look at it as a tool in technology,
Right.
and it's owned by many people. We don't look at it, now there are some that are obviously NVIDIA that's producing chips and, you know, and Tesla, you know, with Grok and all that good stuff. You know, we feel that they are tools. There's not a go-to. It's kind of a battle right now, Grok and ChatGPT, I would argue, right?
Yeah.
So would one of those take over as the go-to? I don't know.
Right.
But I think it's clear in our minds, it's a great research tool. It's excellent. And I mean, I'm right in there with everyone else. I have my AI is named Kai. I mean, you know, I'm in there, man. It's about understanding the limitations, though.
Yeah.
It's not going to be the doctor that's going to understand your personal emotions. It might be able to give you some objective advice with no emotions involved, but we're humans.
Right.
And so we have to remember that. So can it be a great resource? Yes. Can it help us make decisions? Absolutely. Will it understand us? Never.
Right. Right. And okay, now what else do we need to know? What else can you tell us that you think is important? Maybe questions that I haven't asked that you think are important for the viewers.
Sure, absolutely. We talked on one of them, which is get advice from the right source, which is a fiduciary. Okay. Ask yourself the question, do I believe someone is better than me? That's simple. And it's okay to think that someone is not better. It's a theory. It's an actual finance theory. You either believe it or you don't. And if you fall in the category that you do believe it, then reach out to that fiduciary, whoever that may be, and have a transparent conversation about your emotions, your feelings, goals, and aspirations. And then from there, that fiduciary should, and not all of them do, this is a problem in my industry, but should be able to complete a written plan for you. And by written, I mean digital or take-home plan, whatever, but an actual plan that you can have in your hand, that you can understand what you need to do and what steps you need to take to get to where you want to get to. I think the biggest concern everyone needs to be concerned about, and not, I don't want to say worried about, but embrace it. If you're under the age of 40 and you're listening to this, don't depend on Social Security. Don't depend on a pension. Even out to our military folks. I believe we're walking into the day that there will be no more pensions. So your own personal financial investments is going to become more important than it's ever been in the history of the U.S.
What's giving you that idea that we are walking into that world?
It's just been happening. Look at corporations. Think of what corporations still offer a pension when you retire. You don't get the gold watch anymore and, you know, here's your pension. Very few companies, right? Even the military changed their pension model when they executed and put in the TSP. They changed how things are done, and it's constantly evolving. So we're going down that road. There's no question. Very few people will disagree. But are you prepared? please don't try to be the expert yourself. That's my final message to folks listening is don't be the expert yourself and seek the right advice.
Yes, and you have confidence in this fourth quarter as well,
I
despite
do.
the dip
Yeah.
that we've seen today, a
Yeah.
dip midweek last week.
Even though I'm prepared at any moment, because we have a plan, like I said, when you buy, have a sell plan, we are prepared. I'm still confident. I think we're coming up out of the bottom, and we're going to have interest rates continue to go down. And through that, we're going to have our economy start to take off and a better job market and better things. But it doesn't mean there won't be volatility.
Right. And hopefully it won't just impact the Big Seven. It'll impact
Right.
people's grocery prices and
Yeah, absolutely.
wages
That
and things of
everybody
that nature.
can feel the growth and things will be better as a whole. We're due for that. But at the same time, we need to be aware that it's just not easy street. There will be volatility. So managing that volatility is going to become very important.
Very good. Tim Fitzwilliams, we appreciate you coming in. Nia Campbell, do you have any questions for Tim before we let him go?
I was just wondering, with all the expertise you were able to provide us, how can people find you if they wanted to reach
Sure,
out to
absolutely.
an expert?
You can go to fitzwilliamsfinancial.com. Again, fitzwilliamsfinancial.com. And I'm on TV with you guys quite a lot, so you'll see our commercials here and there. Or you can give us a call at 757-961-0700. Then 757-961-0700. We'd love to talk to you. And, if you call us, even if you aren't going to become a client, that's okay. We'll still talk with you and at least give you some advice that we think could help you get on your way.
Right. Oh, and check out the podcast, of course.
Oh, yeah, and check out the podcast, The Green Light Retirement Show.
Very good.
Absolutely. Thank you.
Mr.
Forgot about that.
Fitzwilliams, we appreciate it. We hope to have you in here again
Absolutely.
on
Love
Live
it.
Impact. And
fun.
thanks for stopping by.
Yeah, thanks a lot.